Hi, I'm Dave Brickell, Director of Sales at Paradigm. Welcome to The Big Picture.
Vol is reverting, so the obvious trade is always the expensive one to
this
carry.
whole peak inflation, peak rates narrative, peak Fed, which we've been talking about.
It's an expensive place to find out. Crypto vol, a potentially fatal place to find out.
The crypto option markets are definitely showing some signs of life.
Hey guys, welcome to The Big Picture. Back again. My name is Joe Cruey. I'm at Paradigm in the weeds around everything crypto vol market. I'm joined here again by my colleagues, Sohan Sen in Asia, as well as David Brickell, our macro expert. We're honored and very pleased to have Gordan Grant from Genesis back on the show. Gordan, what's going on?
Hey, greetings, friends. How are we doing? It's what is it? It's March 2nd today. So let's get out there and talk about the last month of the first quarter of 2023.
Good to see you again, Gordan. Good to have you back on.
Yes, and you as well, sir. Pleasure. Hope you're keeping it shiny side up.
Trying to. This market's testing, like it's
yeah,
we're at an interesting market at the moment for sure.
Yeah, pretty cool. I mean, I was reflecting on some end of month commentary for February and basically realized that Bitcoin effectively went nowhere for the entire month of February, even though it felt like we really had some attempts at breakout highs and some huge moves in vol and quite a bit of Vega trading and for us, our largest month actually on Paradigm since August of last year. So it didn't feel like a month where things went nowhere, but I guess we'll see whether March is going to break that spell a bit.
Yeah. It's quite interesting as well in the context of such a sharp rates move throughout February, which has been huge. Obviously, completely undoing the sort of January moves. You'd usually expect, obviously, kind of equities have come under pressure, but like they've given back obviously a lot of the gains from the year, but nothing like given the rates move, you think it'd be a lot worse. And then crypto's just kind of drifted in a pretty tight range. So it kind of like looks quite constructive. And we can talk about this as this goes on, but things like liquidity, China looks quite interesting as well, and liquidity like we're getting from the East, be it from China, Bank of Japan. So there's a lot going on there. So I'm sure this should be a good episode to get your thoughts, Gordan, in terms of what's going on and why is crypto just kind of drifting in this little low vol world at the moment.
Yeah. Joe, I don't know if there's anything you want to use to preface it, or we could just delve into that.
So, I think one of the bigger themes of the month has been this resiliency of the spot vol correlation, which I think this amber data chart shows quite well. So just for context, so this y-axis shows the D-vol index, which is effectively the VIX equivalent of Bitcoin, while the x-axis is the BTC price. So what you see is the highs in implied vols are corresponding with spot at the top of the range. So i.e. that top right part of the chart, while when vols have gotten crushed, that's been happening when spot has retraced back towards, the 23,000 or towards the middle of that range. And I think that vol price action was quite evident at the end of last week. So we had that pretty hawkish PCE data. BTC sells off 4%, and then fixed strike implieds are getting absolutely whacked across the curve, all when the absolute level of implieds are quite low. We're trading like the low 50s here. The vol risk premium was not that elevated by any means. And then fast forward to a couple of days later, where we have that rally back, and then that coincides with vols moving higher. So it really does seem to me like that this vol regime is quite different than in 2022. Like if you told me, obviously I have the equity background. If you told someone 6 months ago, BTC short dated implieds are trading in 50s, trailing realized is in kind of like the high 40s, and spot sold off 4%. Did vols go up or down? I would imagine most people would say vols went up, but that's actually not what happened. So I'm curious, Gordan, in terms of what do you think is explaining this price action, specifically that spot vol correlation in a month where BTC effectively did nothing.
Yeah, it's a great observation. I think there's actually a reasonable amount of alpha in this, and it's good. I mean, we'd like to have some alpha out there for participants in the crypto market, especially those that are transacting on Paradigm. But the reality is that even if Gamma can perform in a sell-off, there's no incremental demand for optionality at lower Bitcoin prices, again, locally here. And I think it's instructive to understand why that is and kind of ascertain, is that a universal axiomatic truth, or is that a state-based truth? And, again, for folks who, sort of follow more of a stochastic methodology for, kind of distributional analytics for crypto, right? What we mean when we say state-based is that there are certain characteristics of the distribution of asset price returns that are not constant. And those could be, the formative parameters of the distribution itself, or the correlative aspects of the distribution of something like the volatility of the asset along with the asset's price. And that could be implied or fall. And we can look at two very simple states, right? Or regimes, right? We've got the bull regime and the bear regime. I think we can all agree we're kind of in a bull regime now, right? Crypto prices are threatening to break out through 25K. We know that's been a huge threshold. There's been a groundswell of readoption of crypto as a thesis. And of course, we've seen a number of the more higher beta, less liquid alternative tokens and L1s have stellar returns. Some of the newer tokens like Aptos, and of course, DeFi tokens like GMX have been on an absolute tear. So we kind of feel like we're in this bullish regime now. We can say what that means. And last year, right, particularly in Q4, it felt like a bearish regime, right, where persistent downward pressure on spot prices, supply of underlying spot or optionality in any rally as people simply wanted to hedge their exposure. And so, you had some underlying dynamics that were completely different between the two. So what does that mean in terms of spot vol correlation, right? Well, last year, if you looked at it, particularly in Q4, we had very negative spot vol correlation, right? So a spot drop, there was demand for optionality because folks needed to protect their balance sheet. They needed to have insurance against further realization of fear, uncertainty, and doubt in the market, and also the looming prospect that we might break out to new lows, right? Break below 15K support. We all remember, the famous Arthur Hayes, Twitter quips where he says, "Okay, I'm loading up on December 15K puts," and everybody kind of went on for that trade, and there was a bit of a storm in a teapot about that. Fast forward to where we are now, we see really quite the opposite, which is after January 11th or 12th. When Bitcoin had an upside breakout from 17, 18K and more or less teleported up to the range that we're in now, right, which is, kind of 21.5, 22 on the low side and 25 on the high side, we've only seen demand for upwards optionality as a trading desk. And so when you look at that from a flow perspective, what does that do? Well, it means that you're going to see premiums expand when people get bullish about crypto prices. Right. And that seems sort of tautological, but it's not really, because it's entirely different from what we saw last year, which is when crypto prices rallied, people just sold a lot of options, right, in order to hedge themselves, to overwrite calls. They figured it was free money. Crypto was never going back up again. And so any bounce in spot was an opportunity to sell calls. And when things felt like they were getting worse, people would spend premium to hedge themselves. Now, fast forward to where we are now, we've got a good amount of profitability, behind the asset classes and industry. People are feeling liquid again. Coin prices are higher. That means you've got more dollars to spend on option premium, particularly as prices rise. And not surprisingly, every time we crest these key psychological thresholds, be it 23 for the first time, 24, or particularly 25, we see players, large and small, crypto native, TradFi, systematic, volatility driven, reaching to buy optionality, right? So that is the regime that we're in now. How long could that last? I think it really depends on certain macro factors to come to where we started this conversation, right? And the underlying factor, I think that's important is the inflation factor, right? And to the extent that you subscribe to a factor-based analytical decomposition of the principal explanatory variables for asset price returns, inflation as a factor seems to be becoming less important, for crypto than it was last year, right? Anytime we would have an upside surprise to inflation, it was absolute disaster. Folks wanted to sell spot, wanted to buy vol, wanted to prepare for crypto prices to facing low, because it simply meant that the Fed was going to be tightening more and more aggressively than in terms of a timeline than people might have expected. Now, that doesn't appear to be the case, right? We've seen ISM prices paid hot. We've seen core PCE continue to run hot. We've seen macroeconomic numbers such as German inflation or China PMIs hot. And actually, crypto has stopped having the same Pavlovian knee-jerk response to that. And if anything, has kind of begun to trade a little more in its own world. That's not to say that we don't dip a bit when there's a strong inflation number in the US, or where there's hawkish Fed commentary about higher for longer. But, particularly since the last FOMC meeting, where there was a 25 basis point, decision and a prognostication that this would be the likely glide path for the future, and that we would no longer be in this shock and awe. That all of a sudden people were saying, okay, you know what? I'm not so concerned about a plunge to new lows. And what it really means is, when things get boogieing, I want to lever up using optionality. And that's really quite different than what we saw last year. And to the extent that implied volatility represents sort of a liquidity preference to utilize options markets for leverage, then we should expect to see this. And it's not really any different than when we look at, let's say, DeFi, perpetual futures positioning indicators in markets like GMX and others that show a tendency to have asymmetric positioning as markets kind of hit new highs. It's just another side of the same coin, if you will.
Right. So crypto is starting to kind of trade in its own world. The macro picture, while not great, as I'm sure David will agree, it really hasn't seemed to matter yet. We've been testing this 25K level quite a bit. I think 5 or 6 times now. And I was out with somebody the other day that said, like, look, we get to 25K. As soon as we hit that level, there's an offer on 200 million fucking BTC 25K on Binance that just comes in and then pushes things back down again. Like in terms of, would you say that it's kind of like a flows and positioning thing that it's bringing it back down to this 25K level? Because we were talking quite a bit about, like, hey, if we break this 25K level, you have all this potential short gamma on the upside. It could get pretty whippy if we could break that level, and obviously that'd be great for the options market and great for people that were generally pretty long that stuff. But what's your opinion on why we haven't been able to break that level?
Look, there's a bit of an heuristic element to it. Which is that's where we failed over the summer in that first initial squeeze rally. So we bottomed on that first flush low just below 18 and then quickly pushed back up to 25. And every time we've had a bit more of a slightly lower high as we've crested there. We had those gamma squeeze pre-CPI highs of right around 24,000 around September 13th. And, yet again, there have been a few other flirtations at that level. So not surprisingly, there is an element of punters willing to take a more balanced approach to this level. There's nothing magic to it, as we know. Although periodically the 200 period moving average has flowed, or let's say coincided with that, and that has also meant that there's probably more of a two-way perspective, at this threshold. But I also think that, speaking of the volatility dynamic, in as much as there's good appetite from players to leg into wingier upside as we break through those levels. And so when we pressed 24, there were buyers of 26s. In February, there were buyers of, let's say, 30s in March. And then as recently as last week, there were buyers of 45s in June. You tend to get more of a local supply of gamma, right, which does start to cap that market. And from what we've seen flow-wise, overwriter activity far less this year than it was last year, which is one of the explainers of this different vol regime that we're in. But it also means that people are more willing to shed some of that upside optionality, I think, from a dealer book perspective, as well as from a tactical trader perspective, and for that select set of overwriters that still have capital, that still have balance sheets, still have coins to chuck into margin either on exchange or bilaterally. That level feels pretty good, right? And particularly when vol starts bumping 60%, when you're up there and you look and say, okay, you know what? I can get, 3 to 4% for near to the money, shorter dated call options. And all of a sudden, right, my break evens are well north of 26K. And so I don't mind letting some of that go. And so it's a function as much of, quantitative metrics, absolute break evens, market psychology, technical indicators. And then I think there's also a more of a fatigue question, just to say we've had a great run up in the market this year. Bitcoin is has been close to 50% off recent lows at various points in time, and basis has also widened back out again. And when we talk about derivatives markets, we shouldn't only stay in the nonlinear space, and that is of course where we tend to spend most of our time focused on paradigm. But basis has moved back up. There is an ability to lob out futures and start to earn, sort of a positive rate of return with respect to where spot markets are trading. And you're either going to earn perpetual futures funding or fixed dated futures. And so as a result, all of those together seem to be providing something of a natural cap at this level. Does it feel like an insurmountable obstacle? I would say no, particularly given the macro trading tape. But does it mean that we have some resistance to chew through here? Yeah, I could certainly see that.
Yeah, and you could really feel that local supply coming in last week, right around that end of month expiry. It was quite strong, not only from like the typical sort of systematic sellers, but also tactically. Like Gordan, I'm sure you remember like all that June Vega being sold, right? You kind of had like that long vol play. People were long the June topside, and then you saw all those June straddles being sold against it. And then you see the steady clips of short dated strangles and straddles as well. And then that combined with the fact that the upside demand was certainly not as high as what we saw back in January at the beginning of the year when everybody was kind of lifting that sort of stuff, then it kind of sort of makes sense. But it does feel to me that, yes, in the listed market, there is a decent amount of systematic and selling flow that we're seeing. But it also seems like there is some large sort of selling flow that is happening OTC. That we don't see on Paradigm. Maybe it's like a minor or something like this that comes in, at the end of every month, because we sold off 4%. Vols got absolutely crushed. I understand that there is not really demand for optionality on the downside, but that move just seemed really extreme. They seemed like there was some sort of like big flow out there that the listed markets just aren't seeing. Am I onto something here, or is it kind of just what you see is what you get?
No, I think that's right. I mean, it doesn't take that much. That's the other thing to remember. I mean, crypto vol markets, let's appreciate the resurgence in volumes here, and not for nothing, right? This is a market now where, your top makers are now all trading well into, the multi-billions of dollars a month on Paradigm, and where Deribit volumes have begun to surpass once more $1 billion per day per product. But that being said, and I remember making mention of some of these things on a prior discourse, and someone kind of laughing and saying, crypto vol, wow, it's not a real market. 10K of Vega is actually supposed to be a serious number, but it is, right? I mean, I think we're getting more liquid, right? And we have to appreciate that. And I think one of the biggest features of February trading was the sheer amount of Vega that sloshed through the markets both ways. Both ways. I mean, we would see guys come and sell, 100K of Vega over a few clips, be it the June sellers or that strip of Feb sales at the end of January. And in this month, it appeared to focus more on March and June. But we've equally seen, an amount of demand for that. And so this is getting more serious, but we're still nowhere near equity vol, commodity vol, crude oil vol, right? Where you think about Forex vol, where you think about millions of dollars of Vega, right? We're at a market where 100K of Vega is a big number, needs to be digested, and can easily move the market, particularly if it's not handled, with discretion. It can move the market 3 to 5 ball points, right? I mean, my general rule of thumb when I look at some of the flows that I see come through the market, unless people are particularly axed, you might well expect to see shorter dated vols back up, let's say 1 point per 10K of Vega. I don't think that's a hard and fast rule, but I certainly do see that sort of tendency. So markets can only accommodate so much. And that also has to do with the winnowing of players. I mean, we feel very privileged to still be here and transacting, and we're very proud, to say that we're at the top of the leaderboard on Paradigm, again, for the month of February. And we're very pleased with the kind of traction that we've gotten with the client base, and particularly, with users of the platform and the large block sizes that we're trading. But not for nothing, there just aren't that many people out there that are still making in size. A lot of the folks that were more active have gotten less active. The vol has been high. There are further incremental restrictions to balance sheet that we're seeing, and again, I don't need to cite any particular incidents, but we're just aware of kind of further credit crunch potential out there in the market as, there are workouts and there are kinds of things that are happening with some of the banking participants. And again, this is all public information in the news. Right. So the ramifications of that are less appetite, less willingness to warehouse this kind of risk. And so when it comes through, particularly, let's say if there's a large one-sided flow that may be done OTC, no one's going to warehouse that anymore, right? Whoever takes that down is going to come to the exchange and is simply going to put that stuff for offer, either top of book or, let's say through aggressive RFQs on Paradigm. And in fact, we've seen both, right? We've seen what I would consider to be relatively heavy-handed execution of Vega sales at various points in time. We saw it just before the Chinese PMI numbers. March 25K calls were given down below 47% implied volatility. For what? For why? Hard to say. But there was 10K of Vega that was just dumped there right around, let's say 5-6 o'clock New York time. And before you know it, it was paid up at 51% within, 3 to 4 hours. Is it rational? No. Is that the kind of market that we're in? Yes, absolutely. And I come back to that's only 10 to 20K of Vega that's traded obviously around a fairly significant data event and in less liquid conditions. But an overwriter or someone that chooses to generate incremental static return through the sale of options, they're certainly going to have that kind of effect on the market, and we should expect this. And as a market maker, I think, we tend to think about trading assets in continuous time, with some, let's say, relatively well-behaved distribution of prices, and be those spot prices or volatility observations. But this stuff just tends to gap too, right? It resets very quickly. It could very well be sort of stable at 50 and then could be, 48 given, 47 given, and before you know it, the market's repriced. And that's because again, we come back to that relatively select set of makers that are able to provide and support liquidity for this thing. And it's more or less where people want it to be. Doesn't mean it'll stay there, right? And quite clearly, sub 47 was the wrong price for those March 25s in that instance. But it can be there and it can be very tradable for a period of time.
Right. Cool. That makes total sense. David, do you want to give us a little bit of a macro update of what you've been seeing over the past couple of weeks? Of course, the data has been running pretty hot, so I'm curious to get your thoughts there. Let me stop sharing my screen.
Yeah, I mean, it's interesting. I mean, just picking up on some of this conversation here. I mean, what's actually really interesting to me is that, how well like Bitcoin and the crypto complex has been like supported. And I mean, coming back to that point about, that kind of resistance around 25K in Bitcoin, it's funny because if you think of like January and it was all about like peak inflation, peak Fed, and that was really like a huge sort of macro driver for crypto kind of pushing to the upside. And now we've kind of lost that, right? That's faded quite a bit. I think it looks super constructive for crypto, just given the lack of pullback. And again, it kind of reminds me of the flip of what we saw throughout last year when, we had these sort of big sell-offs and then the kind of rallies were pretty muted. And then we kind of would be in a bit of a range and then we'd take the next leg lower. So it does actually feel to me that the market right now just needs another kind of positive kind of driver, a macro influence to push higher and take out those 25K levels. So meantime, recency bias and what have you, we kind of like trade in these nice little ranges where people start to get comfortable that, okay, we push to 24K, and above, and you kind of probably want to sell out. And then you sort of dip to low 23s, you kind of buy that. It kind of becomes a little bit self-fulfilling. So yeah, I kind of think like we look like a market that's, again, always sort of careful to say the lows are in, and now we're just kind of waiting for that pause and that trigger to kind of take off. And then also like narratives are important as well, and kind of like Gordan touched upon, like the kind of market psychology and narratives changed like dramatically from last year, and it now feels very much about, say, looking for the top side convexity, and as you're seeing with that kind of spot vol dynamic that we're seeing. So I kind of feel, yeah, we're setting up for that asymmetric move. We just kind of need the data to calm down a bit and rates to calm down. But and you know, we've got the Shanghai Upgrade coming up. We've got obviously as well this sort of news out of Hong Kong looks pretty big.
Shanghai Upgrade is potentially bad, right? Like I'd be curious to get the views around here. I mean, like Gordan, I mean, doesn't really seem like much is priced. Though we did see there was some pretty big March, April calendars that were trading yesterday. You know, there's March, the ETH March, April 1800s. There was what 8,000 of those that were printing, and
yeah, that's right, quite sizable.
Yeah, exactly. And I'm in terms of what you read around it, right? It's and when you speak to people, it's quite mixed, right? Some people are like, okay, it's just non-event, like it's fine. But then others are like, yeah, like Avi Feldman from Golden Tree was on Twitter being like, look, this is potentially attractive time to get long the vol. It's been pretty significant supply. And as you said, you know, because of the vol, it can really overshoot, right? And so when it does overshoot, maybe potentially using that as an opportunity to get long vol, just because, look, I'm not ruling out the possibility that over the short term, there is fairly significant potential selling pressure over time that could happen as people get rid of, people withdraw their stakes.
I think, like, my view on it, I mean, we spoke about this I think last week. I actually think marginally it's like bullish for ETH, partly given the levels that we're at. Because again, if you were gonna, I think most people probably that have staked are probably underwater, right? On that now my view, right or wrong, is that I think there'd be greater selling pressure if ETH was like, you know, north of 4,000, 5,000, and there's actually money in it to kind of realize positive P&L. I think if you were willing to sort of stake and tie up your ETH for an unknown period, it's hard for me to think that as soon as that unlocks, you're going to then sell it and realize the P&L loss on it. So I kind of think there's that dynamic. And then the other side as well is that, you know, you look at like the staking ratios of ETH versus other protocols out there where you can take your money back. I think the increased flexibility, actually, you're probably going to see more ETH that gets tied up and starts getting staked versus that comes out and just gets sold. But I appreciate, you know, there's arguments like both ways on this.
Yeah, Gordan, Gordan Sohan, what's your guys' view on the Shanghai Upgrade event?
Let's Sohan opine so I can have the last man optionality.
Okay, good.
Yeah, look,
like a good trader.
I think for me at least, it is a different world to when these guys staked, right? Like, so it's a completely different world. Their AUMs are, you know, much lower. Like if they're OG crypto guys. So I actually think, on the margin, it probably is a little bit bearish, right? Because, you know, there will be this selling pressure that comes in, and, you know, people are going to have to, you know, finally have some liquidity, you know, which is available, right? So I actually think the case for owning optionality over this is very attractive, right? But I think going back to the previous discussion, right? I mean, there's a big sign of maturity in the market that people are using options now rather than just YOLOing futures, right? So, like, you know, like if you look at all these core spreads or, you know, these bullish you know, trades that are going through the market. I actually think it's a great thing, because these people are coming in and expressing a view using options because they're so uncertain about what the future is. Like, they're like, well, I could be completely wrong, you know, like in 22, I could be completely wrong. Right? So I should use options because then at least I won't completely blow up. Right, so it's like a sign of maturity, right? Like, people are coming in, instead of having a sizable allocation to futures, they're also having, you know, like using options to express their view. So on the Shanghai Upgrade itself, I actually think, yeah, you need to own some optionality over it, I feel.
Yeah, it sounds right. I mean, I think to kind of come back to where we started the conversation about spot vol correlation, I think you have to be mindful of what sort of optionality that you buy. And Ether in particular has been, somewhat more of an anomaly in the sense that we're coming into a major event, and the market has had a persistently negative put skew, and that suggests to me that there's been structural demand for puts, irrespective of the realized spot vol correlation, which has been quite positive, even if it's been less pronounced than Bitcoin, because Ether has been more or less a sideshow this year in terms of volatility dynamics and flows compared to Bitcoin. But nonetheless, when we trade up, to 1700, we've seen multiple instances of major taker activity looking to get leverage long upside, vis-a-vis, let's say, short-term to kind of medium-term factor risk on the curve, and that starting to drive skews back towards flat. And anytime we've sold off, quite predictably, as soon as we get back down towards 1600, vol just gets absolutely shellacked. So, we can kind of wind the clock back and look at the merge and think about how vols performed after that. And of course, it was the case that vol got decimated even as spot was collapsing, curiously enough. And what might happen here? Well, base vols are a lot lower. They're about half of where they were at the time of the merge. So that does count for something. Positioning is definitely a lot cleaner. I don't think there are, huge amounts of leverage long risk in ETH. If anything, right? People have started to hedge themselves. I think the stake ETH question, it's open, right? It depends on the percentage of the folks who are stakers, right? Are they crypto treasuries? Are they just large whales? Are they, smaller scale stakers who have had these assets locked away? I could easily imagine a significant amount of diversification away from ETH to Bitcoin. And of course, we've seen the ETH BTC ratio perform in a relatively lackluster fashion this year. Do I necessarily think that unstaking allows folks simply to dollarize it and kind of cut their losses? Well, they could. Would they? Is that the nature of the people who are hanging on to staked ETH? That's more of an open question for me. I would tend to think more about rotation out of ETH into other crypto assets and less so just pure ETH selling. But I think there certainly could be the event is over, we can unstake now, and let's just get out of it, and we may see a sustained period of ETH underperformance. But I'm also open to the viewpoint, as David has said, that kind of this is a bullish unlock sort of scenarios, as people joke about tongue in cheek in the market, which is to say, supply should drive prices lower, but because the market has effectively preempted that, right, by bidding puts, even though puts over calls have not performed from a volatility perspective, and people may have preemptively sold out some of that ETH or locked in those gains on a forward basis, that there actually could be an effective, okay, if it's finally here and it worked, and now I have the ability to take my money out and put it back and take it out again, right? And isn't this a cool, wonderful thing? The main question for me is, just how bearish or problematic are recent regulatory pronouncements in the United States about staking for a market like Ether, and what does it mean for staking on main chain versus liquid staking derivatives, since this is a kind of derivative focused podcast. The behavior of Lido would not suggest to me that people are done with staking per se. They may feel differently about utilizing staking products, such as those that have come under regulatory fire or those that could be subject to such regulatory censure. But it may well be the case that folks just simply say, hey, listen, I staked there. I wish I'd staked in a more accessible product like a liquid staking derivative such as Lido or others that are coming in the market. There are some, plenty of others that are coming online, and that's new and exciting developments. And that may, simply get us to the point where, there's a bit of selling pressure, but in reality, we just find that people like this idea of a benchmark crypto asset that has, 5, 6, 7% or more staking yield, depending on how you stake, where you stake, whether you use leverage, how you compound your returns. And that it's not a bottom drops out kind of market. And when we talk about the performance of vol, again, resuming the conversation, this just hasn't been a market where vol has performed to the downside. And, without, getting too much into the macro voodoo, I think we can say that there are some things that suggest that the nominal floor, not the real floor, but the nominal floor of asset prices appears to be rising, even with rising rates. I mean, let's all do a quick poll here, right? This is a not a trustless environment. So we're gonna trust a little bit of integrity. But if we asked everyone here at the beginning of 2022 and said, hey, look, you're gonna get 400, odd basis points of Fed hikes in the next 12 months, where do you think US equities are? Right? Would you have said 4,000 on the S&P?
No.
I wouldn't. I would have said yours 3,000.
I would have said 3,200.
Right. Yeah. I mean, exactly. Somewhere like there. And I don't know, so Hunter, David, what your thoughts are, but I tend to get the same answer from people when asked. We would have said yours 3,000, yours 3,500. Maybe you would have said, okay, 25, 35. I don't know, but most people would not have expected it to be here. And we've seen this in other asset classes, right? Gold, silver, precious metals had quite a curious resurgence into Q4 of last year, right? Whereby we saw gold pushing back towards these cyclical highs, and the narrative around central bank diversification, the narrative around, let's say, anti-dollar trades and any number of other considerations. And are we seeing that manifested itself in this slightly funky stability, this perplexing equilibrium of crypto at these levels, even as rates have started to bump higher? And there are some signs, right, macroeconomically, that notwithstanding the amount of Fed tightening, there's still a lot of cash in the economy, right? The home sale numbers recently were quite curious, right? Pending home sales, very strong. And the most important component of that was that cash purchases were at decade highs. So even with interest rates having gone to levels not seen in quite some time, people still have ample liquidity to make major purchases, with cash. And that in itself is somewhat curious. And it seems to suggest to me, as we're seeing with sort of corporate activity, with prices paid in the corporate sector, with some of the, deep cyclicals and heavy machinery, industrial names like John Deere and others, people are saying, hey, you know what? Guys are still spending. I don't know. Tractor prices are still at records. People are showing up and, getting that $200,000 farm all or combine that they always wanted. And paying $1 million in cash for houses in Atlanta, Georgia, apparently, amongst other destinations that have been recipients of, recycled funds from, let's say, the Northeast Rust Belt states. This is all interesting to me. And of course, we're seeing the PBOC do these cash injections. So is the market really, as throttled for liquidity as it seems? I'm not necessarily sure I believe that. And when I really come back to what is crypto after all, right? Like, why are we even here? Well, we're here because we've said it before. Crypto is this beautiful liquidity vector, right? And we know that crypto has survived because of the COVID era injections, massive debt monetization, and injections of liquidity. And I'm still not sure that there's not a stealth liquefaction of the financial system that's happening in ways we may not fully understand. It could be China. Certainly the Bank of Japan, right, who's maintained this bizarre yield curve control, even as real rates have started to turn sharply negative there, and there's been a material weakening of the yen over time. And there is this element in the US of, well, what is really going on? And I do come back to behavioral dynamics. This is not a conspiratorial approach to assessing, prognosis for asset prices. But you have to ask yourself the question, in whose interest is it for us to have a massive equity market correction driven by the withdrawal of policy accommodation? It's not Nancy Pelosi's, apparently, right? I think we all know it's a public record that Nancy is a big buyer of U.S. equities. Yeah. It's also on public record that many other Federal Reserve and appointed officials are big buyers of U.S. equities. They certainly don't go short, at least according to their public financial disclosures. And not only that, household wealth sustenance has become centered on equity markets and real estate markets as a linchpin. So in as much as the Fed has been tightening rates progressively, consistently in an effort to restore credibility after having been kept, sort of long behind the curve, this is really just saving face. And is crypto here in part because liquidity is actually far more ample than policy rates would seem to suggest. And I'm willing to contemplate that thesis. And the longer asset prices sit up here, and the longer we chop around S&P 4000, the more I'm willing to believe that there are things going on in the macro space that are going to bolster nominal asset prices. Of course, we have to ask what's going on the real front. Well, on the real front is 7, 8, 9% developed market inflation, which of course is eroding these nominal asset price returns. And so things are not as rich as you think, right? Because in reality, inflation has been running at this high single digits level now for the better part of several years in the US. And so what that really means is that we need to deflate these nominal asset prices to understand where things really are. And in that sense, of course, crypto has not bounced as much as we think it has, if you believe that. Equity markets are not back towards the highs or within maybe even 15 or 20% of the highs. They may really still well be 35 to 40% off the highs in real terms. If you think about what asset price inflation has done to equity market bottoms during the pandemic. And so with that all being said, right, we trade nominal prices, but we can't ignore the real effects. And is that the case here? And is that one more reinforcing dynamic for this very positive spot vol correlation that we've seen, which is to say, in a rising floor, it's just not that interesting to be long puts for assets. Who would have bought puts on equity markets in Venezuela or Zimbabwe over time? It probably wasn't a great trade. They only ever go up. And we could ask that question here. Is that slowly, not kind of alarmist, not kind of I would say sociopathically, but is that kind of happening in developed markets where asset prices have this floor under them, not because the Fed is going easy on rates? I mean, it's been quite credibly lifting them and being very hawkish in its commentary and using rhetoric that suggests higher for longer is a new reality. But there can be other things going on, and I'm not sure that that's not a component of what we're seeing in the markets right now, both in terms of volatility and in terms of asset prices.
Yeah, I mean that's why I talk about a lot, like within a macro framework, like it's not just rates, right? There's rates, liquidity, dollar positioning, flows, like all these things, right, combine. And I mean, I think liquidity is huge. Also as well, I mean, throughout my career, I always think the two most important things are the Fed and China. Now, most people typically will say, yeah, the Fed, and focus on the Fed, but typically ignore what's going on in China. But I don't think you can ignore what's going on in China. So for all the talk about quantitative tightening and all these things, when you're seeing China do record cash injections, that's going to have an impact. Yeah, and you have to look at that. So I do think there's these huge like liquidity offsets. I do think as well, I mean, like within that liquidity scope, I mean, I've not looked at the latest count, but the Fed balance sheet is not much below 8 trillion still. So that actual QT process has been sort of painfully slow, and obviously you've got the offsets from the sort of TGA drawdown and what have you. So as much as rates have gone up, actually sort of balance sheet contractions been pretty meager, pretty slow, given when you compare it to the injections that we had throughout the whole sort of COVID period. And then the other thing, and I guess to your point, Gordan, is like markets establish like equilibria, like and basically what drives markets is like the marginal buyer and marginal seller at any given point. So I think we like to try and put these things in like neat little boxes and say, oh, well, last time rates were here, stocks would be down here, but the fact is you have like a big sell-off, and then like the market will find like an equilibrium where there'll be marginal buyers that are willing to step in at those levels that don't necessarily kind of relate to a more sort of fundamental view of discounting cash flows and all that sort of stuff. And then the other thing, I was having a chat in the office here earlier and talking about why would you not just hold like treasuries? Like, why would you not just hold, say, I don't know, 10-year treasuries at 4%? Say 4%. And again, and to the point on inflation, okay, but no, when you're doing that, your real return at the moment is pretty much zero. So now has the hurdle to kind of beat inflation mean that you're actually kind of looking for where can I get some level of capital appreciation that's going to outpace inflation? Now, if you'd come into this year holding Bitcoin and you've sort of seen like 40% like return on that within a month or so, equities kind of flew out of the blocks and outpaced the returns you get sat in treasuries. Again, maybe that's a factor that kind of impacts the thought process in terms of your portfolio allocation.
Yeah, I mean, I get the feeling like, I guess the three of you are much more constructive, I guess, than I am, right, in terms of the direction, right? Because I think after 22, I'm just very uncertain that there can't be a curveball which is thrown in there, right? Which is why I'm such a big advocate of like always using just limited downside views when you're expressing directional views. So like I think consistently buying puts in crypto is as Gordan said is not a performing strategy. But when there's this one risk event which might be bad, but you also happen to catch all this like macro events which could turn in this time, I mean, I would just spend some premium and buy some puts. I think that's the kind of the thought I'm thinking.
Joseph, I think that's quite interesting, and I keep thinking back to this and to that point is, so whilst we kind of go, okay, we've lost this Fed put, or it feels like we've lost the Fed put and this central bank put, and now they're more like writing calls, right? What might be quite significant, it was the Bank of England, funny enough, and their intervention in the gilt market last year when that started to sell off. Now, they intervened at a moment when they're in the midst of a rate hike cycle, but things got scary and the bond market started to sell off. Talk about the pension fund, the pension system was about to collapse, and they stepped in again. And I just wonder if that psychology of that is that put is still there, because like, look, the treasury market collapses tomorrow. Like, the Fed aren't going to sit back and go, well, it is what it is, right? It's just, we're in a hike cycle. We need to get on top of inflation. That's your issue. It's not, right? They got to step in. You've had Yellen talking about treasury buybacks and that already, because of bond market, the lack of liquidity in treasury market. So I kind of feel like that, just psychology wise, means that you kind of still feel that there is a central bank put out there to the big blow up scenarios that makes it less attractive to want to own that downside optionality or to kind of hedge yourself against that blow up risk, because you still kind of feel that as when the market's kind of reared its teeth and kind of shown the potential for something nasty to happen, then central banks seem willing to be quite creative in terms of how they'll go about addressing that. And you're seeing it with the Bank of Japan as well, right? It feels crazy, but they know as well, if they step away from that yield curve control, all hell breaks loose. And I think is Ueda, the new incoming guy, actually, he's been quite interesting, in his sort of recent remarks, because everyone's saying he was more hawkish relatively. He's been pretty balanced, right? And he gets that, it's not just about economy, inflation, or these things. It's hard to step away from the support that they've put in there, and if it still feels like there's that support.
I mean, I was out with a client earlier this week, and we were talking about skew dynamics, and especially in BTC, where the downside is just not really elevated, and not to be cynical, but the guy was like, look, if I buy a 10,000 strike put, and the thing goes in the money, am I actually going to get paid on the thing? So perhaps there's also that element where people don't really bid those tails because this is a new market. Counterparty risk is rife. People just are a little bit nervous in that regard, right? So that, especially in BTC, because at least in ETH, right? Like you're always going to have much more persistent demand to hedge the downside in Ethereum, because you have all these VCs that are involved in all these altcoin projects that, Ethereum is going to be correlated to. So whatever, if it's okay, Shanghai Upgrade, but there's also that dynamic as well, especially post 2022 when we, had those blowups where there is going to be, a higher demand for the ETH, for the ETH puts than the BTC. But I think it's 11:02. I think we leave it at that.